And welcome back to Dividend Growth UK. I'm David. On this channel, you'll see how I take advantage of two of the best investment options available in the UK, and they are both tax-free. So, in a recent comment from a viewer, they recommended HICL to me. Turns out I already hold it, and I have done for a while. And for me, it's down over 17% on paper, but that's not the whole story. And today, I'm going to show you why. I own 4,560 shares at a book cost of £7,371. Current value, £6,110. Now on price alone, that's a loss, and a big one. So why did a trust like this fall so far in the first place? It's not really a HICL story, it's a sector story. When interest rates went up hard through 2022 and 23, infrastructure trusts like this got hit across the board. Investors could suddenly get a similar yield from a government bond without the share price risk. Money rotated out and the whole sector traded down to a discount versus what the underlying assets are actually worth. That's not a broken business, that's a repriced sector. So here's the journey. HICL bottomed at £1.10 in February last year, and I watched it for a while. It had a small uptick before dropping back to £1.13 in November, and at that point it fell off my radar completely. Then last month I checked back in and it's climbed to £1.33, up nearly 18% from that November low. Now granted, I've missed out on that growth in any new additions, but at current share price, that is still a yield of over 6%, and that is higher than my target for the SIP of 5%. So if we take a look at this, 20 straight quarters of dividend payments, and it's basically a flat line. Same payout, quarter after quarter, right through the entire price crash. That's not a company scrambling to protect appearances. That's just business as usual for them. Now, while the share price was doing all this, HICL kept paying me. From my first purchase of the stock way back in September 2022, I've received £1,277 in dividends. That alone is 17.3% return on investment. Now we put that together, the capital loss and the dividends, and the total return on this position is plus £16. A holding that looks like a 17% loser on price alone is actually break even, because it never stopped paying me while I waited. So we go back to the 4 questions I asked before I buy anything, except this time I'm asking them about a position I already hold. First, do I still understand the business? Yes. HICL owns a portfolio of infrastructure assets, kind of things that keep earning whether the stock market's having a good day or a bad day. Secondly, is the cash flow still predictable? Infrastructure income doesn't move with sentiment the way that growth stocks do. That part of the thesis still hasn't changed. Thirdly, is management still committed to the dividend? Through the entire drop, HICL kept paying. Same investment manager throughout, no changes at the top. No reason to think that the approach has shifted. And fourthly, does it still pass the 20-year durability test? Personally, I think so. Infrastructure isn't going anywhere in 20 years. The price wobble doesn't change that. So why don't I crystallise the losses? And this really is the whole reason I haven't sold. As long as the dividends keep coming and it's never been cut, I don't see the case for selling just because the price is down. I've got other fallers in this portfolio that might not turn around anytime soon. I'm not pretending every one of them will be a HICL story. But if they're still paying, then I'm not crystallising the loss. Even in the SIP, with the growth built in the strategy, income is still the main goal. Selling a pair at a low price to buy something else doesn't automatically make me better off. It just locks in the loss and hopes the next pick is the right one. Now the counter argument, an opportunity cost. Could that cash have earned more somewhere else over the same period? Maybe it could, you're right. But I can't prove it. But the difference is, this position never stopped paying me while I waited. It's not dead money. It's been earning income the entire time it was down. If I'd sold it at the bottom to chase something else, I'd have locked in the loss for certain, and I'd be betting on the next pick beats what HICL already quietly delivered. So over the last 6 months, HICL has continued to climb. So here's what I'm going to start doing about it. I'm restarting the drip from August, £100 a month, and not because I think it's about to rocket, because this thesis still holds. The price has found a floor, and I'd rather be buying while it's on its way up, rather than waiting for it to look obvious. And restarting the drip at this price will mean that I lock in that 6% returns on dividends. So down 17% on price, flat on total return, what would you do? Do you hold or do you walk away? Let me know in the comments below. As always, thank you very much for watching, and I'll return next time. Until then, bye bye now.